Welcome to the Shikama Live Show with your host, Shikama. Please donate to support the channel in this time of need. I don't have a Indiegogo or fundraiser or anything like that, but you can rest assured that I am in just as much need as everybody else. I think this report that I'm about to give you right now is probably the most significant outside of what's going on that you need to know and maybe you don't normally watch this type of news, but this is some news that will affect you, everybody of all ages, except for children, of course, at each stage of your adulthood. The Fed just cut rates to 0%. Here's what it means for mortgages, student loans, credit cards, and more. I'm going to go over everything, so sit back, relax, or don't relax, or don't sit back, however you want to do. I don't want to tell you what to do. So the Federal Reserve announced emergency steps to help the economy Sunday as business across the U.S. slowed or shut down entirely ahead of the current situation. The Fed's moves, which involves cutting the short-time federal funds rate to between 0 and 0.25% and promising to buy $700 billion of longer-dated bonds to help markets function smoothly. Don't affect consumer directly, though, but that doesn't mean you won't soon feel their ripple effects, which is the notion that it will have. With economists worried the U.S. could quickly tip into a recession, the Fed's action could help prop up the value of your 401k and make it easier to pay off your mortgage and credit cards. At the same time, you're likely to earn less on savings accounts and CDs. So the idea is that by lowering the interest rates across the board, you're not going to feel the impact of all of the outstanding debts that you actually have, which includes outstanding debts such as labor costs. So people will be able to pay labor. Most businesses actually take out a loan to pay you. Then when their income generating stuff is sold, they then pay off all of their loans. So you get paid a lot of times before the owner actually makes money. Some of you probably did not know that. Now, here's what I believe this Fed cut could be affecting all of you. First of all, let's talk about your investments. Usually the stock market rallies with the Federal Reserve cuts interest rates. That's not what happened on Monday morning, however. So they cut the rate on Sunday. Monday morning, still not happening. With the Dow down as much as 10% in early trading, it's a sign of how serious the market regards the current situation. Investors were reacting to uncertainty about a possible economic shutdown. If businesses do temporarily shut down, low interest rates should still make it easier for them to borrow the money they need to pay employees, which I just told you about, and vendors, which is also something that people that need to pay first, until they can reopen, ultimately helping stock prices. As stock prices sink, bonds rallied, with, for example, yields on the 10-year Treasury note falling to 0.15 to 0.85%. Yields move in the opposite direction as prices. So as the yield fell to 0.15% to 0.85%, the prices goes up, which means it's a better buy, right? That's some good news. Last week, both stock and bond prices fell at the same time. That's a troubling sign. Bond markets weren't functioning normally, and part of what the Fed is trying to address with this plan to buy longer dated bonds. I'm assuming if you're an actual investor, you're not watching me to actually get investment information. I'm trying to capture the audience that probably doesn't pay attention to this and probably is unsophisticated, meaning that you do not have $1 million. Can I get a show of hands of how many of y'all do not have $1 million? I know that sounds funny, but it's actually the truth. Higher bond prices should offset some of your portfolio stock market losses. Fund research Morningstar said Monday that the average balanced fund with the 50-50 to 70-30 stock bond mix was down 12.3% on average year to date, compared to 17% for large company stock funds and 28% for small company funds. Now, those figures do not include the Monday's return. On the other hand, lower interest rates should also mean lower bond fund payouts going forward, making it more difficult for investors, especially retirees who count on these meet monthly budgets. Now, I'm not your financial advisor, but if you're a retiree, part of your portfolio should be a lot of municipal and AAA bonds, which can pay you off during your golden years, right? So this might actually be good for a certain segment of you all who have financed your retirement adequately, right? So you want to be safer as you get older. You know, when you're younger, you want to be more up for the volatility and stuff. Like, you're sort of gambling. And these are the people who they're really talking about when they say the stock market is a gamble. They're talking about young investors who can really waste $1 million. And it's okay. They'll gain that $1 million back over the course of the rest of their life, right? You do know that depending on every something like $50,000 in income that you will make over the course of your lifespan, $1 million to almost something like $10 million as a regular human being. See, you have to keep your expenses low, and this is how you're going to recoup everything and save for a rainy day, right? That's just general saving. That's general financial advice. Now, let's talk about mortgages. For the past several weeks, mortgage rates have been at or near historic lows, and refinancing applications have spiked. As of late Thursday, the average rate for a 30-year fixed rate was low as 3.36%, just a hair above the all-time record low of 3.29% rate set the week before. The average rate for a 5-year adjustable loan was 3.01%, and for a 15-year fixed loan, it was 2.77%. The Mortgage Bankers Association said refinancing applications have jumped fivefold since 2019. In theory, the Fed's rate cut could bring average mortgage rates even lower. Mortgage rates are typically pegged to yields in the 10-year Treasury note, which, as we mentioned above, are falling. But there's no guarantee that will happen. Key mortgage rates actually rose last week due to problems in the markets for mortgage-backed securities, even as stock prices continue to tumble, which they already said, which is not normal, and is one of the key reasons the Fed decided to act Sunday, purchasing billions in mortgage-backed bonds in the addition to moving short-term rates lower. So while homeowners are already benefiting from historic low rates, it's impossible to say whether they are likely to move lower. Let's talk about your credit cards. Another piece of good advice, good news for consumers. Borrowers with revolving loans, such as credit card debt, should get some relief with lower APRs. Following the financial crisis, Congress implemented regulations to protect customers from having their credit card rates hiked without any warning. In response, issuers switched their offerings from fixed-rate cards to variable-rate cards en masse, which means that the APR you pay can change based on policy moves like rate cuts. Here's my advice for Black people. Do not get an adjustable rate credit card. I repeat, my advice for Black people, I am Black, by the way, in case anybody was confused. My advice for Black people, do not get an adjustable rate credit card, okay? Variable rate credit cards have a rate tied to the prime rate, which is 3 percentage points above the benchmark federal funds rate. So the central bank's weekend move will change the prime rate from 4.25% to 3.25%. Variable rate credit cards have the APRs that are a certain percentage above the prime rate depending on borrower's creditworthiness. credit worthiness. So when I talk about black people do not need to be getting a variable rate credit card, we want to take a look at the overall credit worthiness of black people in general. This is just general findings, general stats, data that I normally look at. And I only look at black people. I don't look at anybody else. I only look at black people. Again, I'm black, so I have a vested interest in looking at black people and the data about black people. So the credit worthiness of black people is the lowest out of all the groups. So the advice is to do not get a credit card based on a variable rate based on your credit worthiness tied to the Fed funds rate, right? Get something that you absolutely know that you can pay off and something that you can depend on year after year, actually, right? This is how you invest wisely. Why? Because not everybody is a nice, gentle, and kind shikama in the world, right? Some of them will give you a nice little variable credit card, and then jack it up to 13%, 19%, 26% when you're not looking. No, we're not talking about 3.5%. We're talking about 30%. Okay? So your credit card debt all of a sudden it goes up tenfold, and you have absolutely no warning about it. But Mobes added that the reduction in the APR might not be as big as you expect, given the size of the Fed's cut. This is because of how issuers do the math, typically relying on their 6 to 12 month moving averages. Let's talk about student loans. The federal rate cut doesn't directly affect borrowers who have already left school and are in repayment. Those borrowers may see some relief from a policy announced Friday that waives the interest on federal student loans. But it does mean people planning to take out student loans for the upcoming 2020-2021 academic year will get rates that are close to record lows. So that's good for brand new students. Probably not so great for these people already who are repaying their student loans. However, let me repeat that those borrowers may see some relief from a policy announced Friday. If you want me to go over that, I will go over that in the next video of you. So if we get 1,000 likes on this video. I'm serious. If we get 1,000 likes on this video, I'll go over each and every part that you want explained. Interest rates on federal loans are fixed over the life of the loan, and since 2013, the annual rate on federal loans are set each May, based on the results of the 10-year Treasury note. If student loan interest rates were set today based on a recent 10-year Treasury yield, they would be about 3% of your undergraduate loans and 5.5% of graduate student and parents. By comparison, interest rates for the current academic year range from 4.53% for undergraduate borrowers to 7.08% for graduates and Parent Plus borrowers. For those repaying loans, it is likely the Fed cut will drive down the rates offered by private lenders, which means you could get a lower rate by refinancing your loans into a new private loan. Even before the decision to cut rates to zero, interest rates offered for refinancing were among the most competitive we've seen in years. Pay attention to that. So once again, black people, pay attention to if you have an outstanding student loans, take a look at the interest rate on the actual student loan and see if it would be in your best interest to refinance with a private lender. All of the rules and regulations are not going to change at all, but you could refinance to a private lender. The private lender, of course, will be happy to refinance for you because they want to take on a federally guaranteed student loan, right? So don't think that you don't have a chance to refinance. You do. Note that there are cons to refinancing federal loans. If you want me to go over that, let's have 1,000 likes on the video, especially in a period of economic uncertainty. Your savings account. While borrowers stand to benefit, savers will lose. The dramatic 1 percentage point decrease in the benchmark Fed funds rate means that the already paltry returns you can earn on interest-bearing checks and savings accounts are likely to drop even further. Let me explain something to you. If you have ever seen a financial report or financial news or CNBC or Bloomberg Finances or Fox Business, they're always talking about investing in the dollar. Investing in the dollar literally means stuff like you have a savings account that simply generates interest and you are paid in dollars. If you are a somewhat smart investor, then when the dollar is not up to snuff, you take that money that you would be saving, keeping in a savings account, and then you invest it in something else, like bonds, like bills, like other stuff that is a little bit more secure, but isn't totally just a savings account, right? And can actually pay you some sort of income from it, right? If you have enough money, it's quite a bit of income, right? If you have a whole bunch of money, right? So you should look at your portfolio and make sure you have a little bit in this and a little bit of that. And then savings is supposedly, right, 100% secured up to, what is it, 250,000? Federally guaranteed or something like that, federal insurance. The growing concern right now and the havoc it has wreaked on markets and economies around the globe have already been weighing on deposit account rates. Mobe says, quote, "We have seen deposit rates decline gradually since the president stopped flights from China in January. Deposit rates will decline more rapidly with the current travel and social distancing restrictions being put in places," he predicts. In general, the lower overhead enjoyed by online banks lets them offer somewhat higher interest rates. So if you're sitting on cash and want to realize some kind of return on those funds, opening an account with an online bank might be of an option to you. So if you just must, at the very least, that you can understand, because you should only invest in stuff that you actually understand, right? Otherwise, you might lose your money. You have no idea what's going on. You can then shop around for the best possible bank account, and sometimes that's online. And in fact, at the lowest of the lowest of the lowest Fed rate, which was actually negative at some point, literally that you were basically paying them to keep your money instead of you actually receiving money from actually having a savings account. The online banks were being competitive with the brick and mortar banks, such that the online banks were able to offer more of an interest rate than any other banks that there were. So I'd advise you, if you absolutely must, have a savings account, and that's the only thing that you can understand and you can get a hold of and you can, feel comfortable with, check online with the online banks. And that's not something that I'm going to advise you which one, or I'm not going to recommend you anything unless you absolutely must have that information. And then only if you pay me to actually take a look and research it for you, meaning that you have some money to actually put into an account. And we're not talking about $200. We're talking about you have a lot of money so that it's even worth even talking about. I'm not talking about, I don't want tire kickers to say, well, Shikama, how much is that? I want you to go research that for me. Actually, if you pay me $250, I'll go research for it, even if you're just curious, right? Thank you all for watching. Make sure you thumbs up. Let's get those likes up to 1,000. And leave a comment. Bye-bye.